Delighted to have the opportunity to introduce our guest speaker, Dr. Lekha Chakraborty, who is presently a professor at the National Institute of Public Finance and Policy and Autonomous Resource Institute under the Ministry of Finance. She is also affiliated as a research associate with the Leva Economics Institute of Bard College, New York. She is the pioneer economist in institutionalizing gender budgeting in India with Chief Economic Advisor of Ministry of Finance of Government of India in 2004. Her areas of interest are macroeconomics of public finance, fiscal federalism, financing human development, and gender budgeting. She has authored many books, including Fiscal Consolidation, Budget Deficits and Macroeconomy, and Social Sector in Decentralized Economy, India in the Era of Globalization, amongst others. She has worked for the IMF, World Bank, the UNESCO, the UNDP, the UN Women, and the Commonwealth Secretariat on short stints. Her work experience on macro fiscal policy and human development is quite expansive. She was twice an awardee of Shastri Indo-Canada Program from the Department of Foreign Affairs and Trade of Government of Canada. She was visiting professor at American University, Washington, D.C., Uppsala University, Sweden, Carleton University, Canada, and University of Utah, US, on gender, macroeconomics, and international trade courses. She received PhD in economics in 2004 from the Center for Development Studies, Jawaharlal Nehru University, where she also taught as an associate professor for 1 year, 2007 to 2008. She has numerous papers published in national and international journals. We are immensely grateful to you, ma'am, for being able to take out time from your busy schedule and enlighten us on a very pertinent topic today. I would like to now request you to tell us more about the monetary and fiscal policy challenges. But before that, participants are requested to put their questions in the chat box. They shall be taken at the end of the session. Ma'am, you can continue now.
Okay, it was a little unclear. You're asking me to go ahead?
Yes, ma'am.
Okay. Thank you so much. And a special thanks to, Nitya, my friend, for asking me to come and speak to the students. And a special thanks to the principal for making this event possible today and for accommodating, my request to conduct it today evening because of some contingency happened. It's always a pleasure to talk to students. And indeed, I have spoken to the students of Nitya first when the pandemic broke out and the world stopped. So that was the first event I have done in 2022. So it's my great pleasure to return to speak to Nitya students, And this time I will be speaking to you about the monetary and fiscal policy linkages and how we can respond through these policy initiatives to the global uncertainties and the pandemic. And, let me begin with the monetary policy stance. As your professor rightly pointed out, now IMF, it's high time that it is IMF, it should be IFF or IF squared. That's quite true. And let me take my clue for this lecture from that particular point of your professor. Unlike the global financial crisis that has happened in 2007 or 2006-7, this time when the global uncertainties are mounting and when we are passing through this extraordinary time caused by the COVID pandemic, we depend on fiscal policy stance more than the monetary policy stance to avert this crisis. Of course, with the monetary policy and fiscal policy coordination, but not with the central bank independence. But after the financial crisis, monetary policy tool was the predominant policy tool to respond to the crisis. But we understood that, it led to the liquidity trap beyond a point. Rate of interest as a policy tool, whether it is as a counter-cyclical policy tool or whether to respond to the crisis, was not happening beyond a point. So we understood the limitations of the monetary policy stance, in the aftermath of global financial crisis. especially, this liquidity trap, the negative real rate of interest, everything. But right now, in a way, it is a kind of fiscal policy dominance that's happening, because to avert the crisis, we need to look into three important components. One is the inflationary pressures right now. Second is the energy price volatility that is happening right now. And third, the pressure on the currency. So earlier, especially in the context of the taper tantrum, I need to add that point also, because, Fed Reserve, they are in a mood to increase the interest rates. And, that beggar thy neighbor hypothesis is working quite well now, because emerging countries are unable to, cope up with the kind of, the taper tantrums and the kind of the potential series of interest rate hikes that is going to happen from the US Fed Reserve. Jay Powell was quite clear even in the Jackson policy meetings that he will go ahead with the rate normalization, or he will go ahead with the hikes in the interest rate. But that led to many fragile economies like Brazil, Turkey, India into crisis. So we need to co-read the global uncertainties that is happening from the mounting, energy crisis, the war in Ukraine, and what's happening with the Fed Reserve policies. And to add to that, we have our own internal issues of growth recovery process. And in this context, against a backdrop of all these global uncertainties, and of course the internal growth recovery process, RBI is in a bind. As an RBI governor, if you are asked to do a policy of take, what you would have done, you can just superimpose yourself in that seat and think about it. And two policy options to make things easy I can put forward on the table are whether to increase the interest rate to respond to the crisis, or to keep the interest rate lower and status quo. So why I'm saying so, to keep the interest rate status quo? Because if the central bank increases the interest rate to prevent the capital flight, which is happening from the rise in the interest rates from the US Fed and the other global uncertainties of mounting inflation and energy price volatility, then the growth recovery process will suffer. But in order to keep the growth recovery, that means you have to provide cheap credit, investment has to happen, then interest rate needs to be lower. So if you keep the interest rate lower for a continuously, it's for the prolonged time, continuously for a long time, then what happens is that anchoring the inflationary expectations will go haywire. That's why one of the MPC members, Jayant, he is making right noises regarding the reputation risk of central bank if they are continuously keeping the rate lower when inflation is mounting. So argument is like this. The central banks all over the world, not only India, do believe that these inflationary expectations or inflationary pressures are transient in nature. That's the argument they put forward. Transient in nature because of the supply side disruptions, the supply chain disruptions, and also due to the war. But in the long term, things will go all right. So the inflation is transient in nature. So that's the argument. But we know that, beyond a point, this argument is not quite valid, especially when inflation hurts poor people. And by mandate, RBI is supposed to look into only the price stability or, financial stability. So the argument is that if that price stability is not given adequate importance when it comes to the point of a trade-off between the economic growth recovery and inflation containment, right now, more or less, RBI is on board with that growth recovery process. And another aspect to look into by linking it to fiscal policy is RBI as a public debt management organization. So it's a conflicting interest. In the sense, like, you have to keep the interest rate lower for public debt management purpose. Otherwise, if you increase the interest rate, because our mode is a accommodative fiscal mode right now, our debt and deficits are mounting. So you know that the inflation payment as a part of revenue receipts will mount. So if you increase the interest rate, those interest payments, that component is going to mount higher. So when there is a conflict between that fiscal policy stance and the monetary policy stance, then RBI governor has a tendency to keep the interest rate lower, because North Block, that tug of war always happened between North Block and the Main Road. So in order to pacify the North Block also, you need to keep the interest rate lower for the growth recovery process, and also from the point of fiscal space and public debt management. But you can ask me a question, what about financialization of savings? That's important for investment cycle, and then comes the growth recovery process. For financialization of savings, if the interest rate is declining or it is kept at status quo for a long time, then of course people have the tendency to diversify the portfolio to other methods of savings from the financialization of savings. So that then, what could be that equilibrium rate of interest that can keep the financialization of savings to a threshold level, and also to keep the investment optimum. That's a miraculous rate of interest, and there are different models to work it out. But right now, the priority of Indian Central Bank, that's quite contrary to the other center banks, because other center banks have started the process of raising the interest rates. But Indian Center Bank, we are keeping the rates lower for the growth recovery process, because that's of the paramount importance to the Indian Center Bank right now. Now, inflation, if you look at, there are two components. One is a WPI inflation and the other is CPI. And you can see that there is a wide divergence between the CPI and the WPI. And the WPI is mounting above 13 or 14%. And the CPI, of course, it's little beyond the comfort zone right now. What exactly is the comfort zone? By the agreement between the North Block and, RBI, there's an institutional reform that has happened in India. That's in February 2016, that we entered into a new monetary policy framework, and everything is based on the inflation targeting. So it's a kind of rules-based monetary policy framework right now. And as per that new monetary policy framework, the crucial concern or the important objective, or even the single most significant objective of the central bank, is to look into the price stability. So that's a concern. So that's why, Jayant Verma has raised the point that if you're focusing on growth recovery process by keeping the interest rates at the low point, then beyond a particular period, can it lead to reputation risk if you're unable to control the inflation? And now CPI inflation is also mounting, beyond the comfort zone. Comfort zone in the sense, the inflation, that anchor, in India is 4% officially. And we have a band like plus or minus 2. So you can reach up to 4 plus 2, 6%. So CPI inflation till 6%, we are in the comfort zone. But beyond 6%, it's a matter of concern. And now we are slightly, above 6%. And that CPI is an inflation which RBI takes the control, not the WPI. Now, I have spoken to Ashima Goel in the meeting, and in that particular meeting, my doubts about the inflation targeting framework, I asked her whether we are able to anchor the inflationary expectations. That's exactly the reason why, unlike a prior 2016, we experienced like 11%, 12% CPI, but right now it's around 6, or more or less it's hovering around 6%. So is it because the central bank is able to anchor the expectations properly, or any other reasons? And then she pointed out one thing, that in earlier times it was not the WPI which was like 13 or 14%, it was CPI which is mounting, but WPI was lower. Right now our challenge is the other way around, and if there is a divergence between the WPI and CPI, and WPI, it directly hits the business community, right? And now, especially when you look into the small firms, small businesses, they are in doldrums, and we have not announced any fiscal stimulus packages, to deal with this crisis, what's happening with the, the small business firms. So in that sense, if the WPI, CPI, that in interest rate, I mean, in this inflation rate, if that is also, widening like anything, then it's a matter of concern. And RBI looks into only the CPI inflation. So let's keep that question, let's save that question about the inflationary expectations. And students should take a look into Rubini's work. And against a backdrop of Russia, he has written an article on Russian war and its implications. So there, this monetary fiscal policy coordination that was articulated so well. And there, he mentioned, he highlighted a point that if, central bank bites the bullet and hike the interest rate, then the growth recovery process will be hampered. But it's like he has explicitly mentioned about that dilemma with the central bank or the monetary policy stance, like if you bite the bullet or not. There is a policy dilemma, because as I mentioned, I was trying to articulate that particular point only, that if you raise the interest rate, then you had it. If you don't raise the interest rate, then also you had it. So that's a kind of situation with the central bank. Now let's look into the question that how fiscal policy can look into this matter when the monetary policy stance is partial in its impact. And along with the rates, maneuvering the rates, another important policy that has happened from the monetary policy front is liquidity infusion, because we nudge the commercial banks by keeping the monetary policy corridor accommodative. And also we have not touched upon the
गाता गाती होगा कोयल.
Okay, the smallest, student. I mean, you're okay?
Yes, ma'am, we're good.
Okay.
Sorry, ma'am. Yeah,
Okay.
please go ahead.
So he got excited when I talked about, the monetary policy stance and infusion.
Yeah, too much new knowledge. Yes, ma'am.
Liquidity infusion, as a policy narrative to tackle the economic stimulus, as a part of the economic stimulus package. Why it doesn't work? Because of the uneven access to the credit deployment. That's why the students can also take a look into the Stiglitz and Rashid. There's another paper, which economic stimulus works. And in that paper, it was explicitly mentioned that the credit-related multipliers, that is limited. The credit-related economic stimulus packages have limited multiplier effects. So if that is the case, and if India or our neighboring countries, if we are designing the policy packages predominantly as a credit infusion technique, then the recovery will also be uneven. That's exactly what we are at the receiving end right now. In the sense, economic recovery, of course, is happening, but that recovery is just focused on certain segment of the population, which is at the higher end. But what is happening at the lower end of the pyramid, that's a matter of concern. And the economic stimulus packages, especially from the fiscal policy, we have not done adequate enough. So that's what I think I have spoken about it over WhatsApp with Nithya also, that we need to go outside the purview of the budget and start announcing certain policies from the fiscal policy front to address the concerns related to the uneven recovery, because monetary policy, it's unable to look into the redistribution aspects. It's unable to get into the widening or the uneven recovery, because the prime objective of the monetary policy is price stability. Through controlling the inflation, of course, you can control a certain element of the humanitarian crisis by, preempting that high prices and all, which will be going to be, detrimental for the poor people. So, that inflation containment can be done by the monetary policy. Other than that, fiscal policy has got a major role to play. And there, what has happened, what was the articulation? Fiscal policy targeted on the capex. on the investment potential of our country. And we have announced high capital infrastructure to crowd in private corporate investment. So that was a narrative of this budget. We are focusing on the capex, on the capital spending. At the same time, if you look into the elements of the revenue spending, the assumption was more like, we were going towards a process of normalization in the revenue budget. And if you go ahead with the normalization process in the revenue budget, especially in the time of pandemic, that can affect the food security, employer of last resort policies, social protection measures, social infrastructure policies, and health and education. So all these elements, this is not the right time to control the revenue deficit. This is not the right time to control revenue spending. But if you look into the budget meticulously, the articulation from the fiscal policy front was towards, capex, and there was a normalization procedure that has happened with respect to the revenue deficit. But phasing out of revenue deficit in the time of pandemic, that is, that's detrimental, because revenue deficit, phasing out of revenue deficit means all what you earn through your revenues receipts, you use it for your revenue expenditure. Anything greater than that, whatever you borrow, that will go directly for the capital expenditure. So that's a narrative of revenue deficit has to be zero. But I do believe that in the time of pandemic, the borrowing program can be also extended to address the issues related to the revenue spending, not only the capex. So that golden rule in the fiscal rules based economics, that golden rule of phasing out of revenue deficit, that is not good at this moment. But I think our government is slowly proceeding towards phasing out of revenue deficit, because last year, you remember, revenue deficit was 7 and fiscal deficit was 9% or 9.2%. But right now, we pegged it at 6.4. But when you look into the revised estimates of the last year, the fiscal deficit is 6.9, because we pegged it for 6.8. But now you can ask me a question: if our macroeconomic fundamentals are not strong, whether it affects the investors' confidence. That's very crucial for the private investment to kick in. Their communication is very important. How finance minister communicated her high fiscal deficit number. That communication for an accommodative fiscal policy stance, that became crucial, in the sense she mentioned that she has high fiscal deficits, but we don't fear high fiscal deficits or high debt in the time of pandemic. And see, she substantiated with the argument that this high fiscal deficit she is using for financing the capex. And students must have read the Oliver Blanche's paper on public debt in the time of crisis, that he has written prior to the pandemic. In that paper also, he mentioned that high debt and high deficit can be substantiated if it is using for financing, or if it is using for capex, capital infrastructure investment, and also to reduce the output gap. Output gaps, sectoral output gaps, because if you compare the productivity across sectors, you have a potential output and actual output across sectors. And if that output gap, the gap between the potential and actual is huge, then you are into, a bad kind of economics. But I will tell you why this output gap itself is a controversial variable, because if you look into the pandemic economics or a crisis related framework, analytical framework of growth cycles, and exactly what Geeta Gopinath and her co-author Mark has written in the paper Cycle is Trend, in the context of emerging economies, this business cycles, dating the business cycles, may not be an appropriate methodology or an appropriate framework to capture the growth events. You know why? This drop that has happened in the GDP in the time of crisis may not be a cyclical drop or a cyclical deviation. It can be a permanent scar. So you need to distinguish between what are the permanent scars. Then the policy you need to formulate will be little different than you maneuver the policies as counter-cyclical policy tools to correct the cyclicality. these are two different kinds of policies. So that's why, in the time of pandemic, if you look at the economic policy packages, there were two components, like instantaneous firefighting packages to tackle the cyclicality elements, and also they use this opportunity, this crisis as an opportunity to, float certain structural, reforms as well. And these structural reforms were related to agriculture sector, of course, but there was a, U-turn from that, because of the lack of consultations and the way it has happened so quickly, that was bound to happen. And the labor market reforms also, we are into same danger when we look into the consultative processes. But the tripartite consultative process is important when you go for a labor market reform in terms of, your industrial relations between management, trade unions, and the government. So that's very important when you look into the labor market reforms. Then another important area for the power sector reforms is the structural reforms, is the power sector reforms. And how that's done, if you look into the fiscal policy stance of the subnational governments, of course, there's an articulation to go beyond 3% fiscal deficit to GDP ratio. Right now, at the subnational governments and the state governments can go up to 4% of GDP, their fiscal deficit to GDP. But, it's a kind of nudging process. The center bank is nudging the state governments to, go ahead with certain structural reforms. Structural reforms so that, especially in the power sector, so that this extra borrowing space which is provided to the, subnational governments is related to structural reforms. But if you look into the statistics of the financial efficiency parameters and the operational efficiency parameters in the in the power sector, things are not good. We have done a study. My, for the Amandeep Kaur of NIPFP, myself, Divi Rangan, we have looked into the financial parameters, efficiency parameters, and certain elements I can highlight. One is the difference between your aggregate cost and aggregate revenue. That has to be minimized. But if you look at the state-wise data, that is not happening. And students, if you're interested, you can take a look into the dashboard data of the power sector reforms. And another one is, the aggregate technical and commercial loss. That has to be minimized. But if you look into the data, some states, of course, they have done very well. But, power sector reforms are not complete in terms of the financial parameter or the efficiency parameters in certain state governments. So what is the end result is that though we have floated a non-SLR bond to clear up this mess with the discom companies by providing guarantee, the state governments were providing guarantee to clear up this mess, but state finances, that deteriorated. But at the same time, the problems related to the discom companies were not sorted out. Now, in the last budget, they announced even the privatization of discoms, distribution companies. Otherwise, the generation of electricity is quite perfect in the context of India to go ahead with the 100% electrification of villages. But our power sector companies, distribution companies are not doing well. So we need to correct that mess in order to get the, benefits of the, power sector. That's why this discom, to focus on discom is quite relevant. And even after privatization, if you look into these operational efficiency parameters and financial parameters, things are not good. It is state-wise differential. Some states are doing good, but most of the states, if you look into all the parameters, there are issues related to power sector. So we need to focus on the power sector. So that 0.5 of extra borrowing space which was provided to the state governments, that is related to the power sector reforms. Otherwise, 3.5, that's okay. But this extra 0.5 in that, fiscal rules which are allowed to the state governments, that is, we have to nudge the state governments to go ahead with the power sector reforms. And another important element with relate to the public investment infrastructure in infrastructure or public infrastructure investment, it's not only the center government that does capex investment, right? We have to nudge the state governments also to go ahead with the front loading of capex. So for that, around 1 lakh crores, interest-free loans were transferred to the state governments to go ahead with the front loading of the capex. So we hope that the investment cycle will trigger. Of course, this multiplier has got, it will be operating only with the lagged effects, but we are hopeful about it. And crowding out, that finance minister refuted the neoclassical argument that high fiscal deficit or high public investment crowds out, high public investment crowds out private investment. So that's a way, we have learned in the textbook, but from the position of strength, finance minister refuted that argument. Like what she has owned is the narrative that high fiscal deficit is okay. We are substantiating it with linking to the capex infrastructure, and this capex infrastructure, rather than crowding out private investment, it crowds in. And of course, empirical evidence also proved that it crowds in rather than crowds out. And, I have a paper with, Rishikesh Vinod, the econometrician, and IMF colleague Karen, and we have written that paper, and that paper is in the handbook of the statistics that are, that is published by Elsevier. Students can take a look into that paper. The title of that paper is Encouraging Private Investment. We used a wonderful methodology called MEBOT, Maximum Entropy Ensembles methodology, to go ahead with the modeling of the private corporate investment. And, econometrically, it was a short time series, and econometrically, you get into trouble if your variables are integrated of different order. Like you have I1 and I0 variables. That is a stationarity test when you do prior to running the models, because, that stationarity is quite crucial. And then, you get into issues if your variable is a mix of I0 and I1. So what are the methodologies in time series to tackle with these issues? And one is, of course, ARDL to a certain extent. And you can also look into the Todo and Yamamoto and Econometrica paper. You calculate on the basis of the number, the order of lags and the order of integration. So that's a way to, worked on that aspect of, tackling the I0 and I1, that mix of variables. But in the maximum entropy ensembles, short time series if you have, but the beta you generated will be from the ensembles. It's like reincarnations. From the short time series, you create ensembles, and the new beta from all the ensembles created, that beta you need to look within the confidence interval, whether that coefficient is significant or not. And it's a very interesting way to look into these aspects of short-term time series and the mix of I1, I0. So using this methodology, we came to the conclusion, or we got the inference that for private corporate investment, it is public investment. That's a significant variable. And of course, monetary policy stands to the interest rate determination or the interest rate changes. That is also a variable which is relevant, but public investment is crucial. That's a single most significant coefficient to trigger the private investment. So right now, that policy imperative has gone from the finance minister in her budget speech, and India is testing it. And I hope that the recovery, because earlier we have done the bankruptcy code, there we have floated many structural reforms in order to get the private investment back on board, ease of doing business, but something was not working. And that exactly was the huge public investment to support the private investment, not only the statute or the other structural reforms. So let's wait and see whether this is working or not, and whether this is triggering the investment cycle. So we have to wait and see. Now, crowding in and crowding out, that could be direct or financial. Direct crowding out is like $1 increase in the public investment crowds out $1 investment in the private sector. So that's the way it happened. And financial crowding out happens through the interest rates. Like if the loanable funds are limited in an economy, and if you preempt that loanable funds to finance the deficit, then what is available to the private corporate sector can be limited for investment. So that's the way it is argued. But right now, you can understand that this is refuted from the perspective that we are preempting the laws not for fiscal profligacy, but we are using it correct for triggering the investment only. So that's a way that communication happened from the finance minister to look into these issues. That's the way it was articulated to the investors, and investors' confidence will not suffer, because I have read after the announcements, one question which is increasingly asked by the credit rating agency was, what is your fiscal consolidation path? That is like, it is not clear. Then we have to mention that communication, that what is the medium term fiscal consolidation path. There finance minister has articulated that by 25-26 fiscal deficit will go back to 4.5, not 3%, as per the original fiscal rules. It will go back to 4.5. From 9 it is now reduced to 6.8, but it will go back to 4.5. Why 4.5 instead of 3? One way to explain it is like, a certain fiscal transparency or budgetary transparency was given emphasis by the government of India in the last budget. Like some off-budget borrowings or the public sector borrowing requirement, if you compute that, the general government deficit plus the deficit of the public sector enterprises you need to incorporate, right? So we don't have a PSBR in India. So the macroeconomic coverage of a deficit, what is that parameter in India? It is fiscal deficit. So the borrowing that is happening through the public sector entities are not the part of fiscal deficit. So last year, for budget transparency, certain OBB, off-budget borrowings, were incorporated into the fiscal deficit to make the budget more, make the budget transparency or budget more transparent. So that initiative is welcome, and incorporating that budget transparency issues, if you are going ahead with 4.5, then it's okay instead of 3. That's the way it is articulated, but by 25-26, not instantaneously. Because in my book, I have written it prior to the pandemic, and I know that Nithya students must have read few chapters of my work related to the crowding out. Deficit is not a villain that crowd out private investment. That's the way that chapter's empirical evidence came out. And I also have written about the financial crowding out in another chapter, looking into the interest rate determination. So there, it's not that correct that deficit is bad, because my empirical evidence also proved that a timely deficit is good. It's good for the growth recovery, and its linkages with other macro variables are not that great that deficit is a villain behind high inflation, high interest rate. It's not like that. Rather, deficit supports. A good deficit always supports the economy. So that's the way that book came out. And we have two policy options right now: to go ahead with the central bank independence, or asking the central bank to support the fiscal dominance. And always in India, it was like unpleasant fiscal arithmetic, unpleasant monetary arithmetic, we always believed in R and G, the rate of interest in real terms and rate of growth of the economy. In the sense, if you may have high fiscal deficit, you may have high public debt, but if you're growing out of it, then that's fine. That's why if your G is greater than R, what is R? Real rate of interest is the cost of credit, and G is a growth of economy. And if your growth of economy is greater than the R, that means you're growing out of your debt, then that's fine. But using the debt, if you get into fiscal profligacy, and if you get into the freebies to incentivize the voters, or you get into a kind of prolonged welfare models can be good and bad, but of course not a kind of freebies. So these will lead to problems. Otherwise, if you use the enhanced fiscal space from the debt deficit dynamics correctly, then you can grow out of your debt, because your growth path will be higher. And look into Telangana. It was a new state. So they needed the fiscal space to get into the robust growth path. So what was the policy strategy? They have elongated the maturity structure of the bond market. In the sense, if you look at the debt structure of Telangana, the short-term bonds are less, and the long-term bonds are there. In the sense, like after 40 years or 50 years, you have the refinancing risk. Why you're postponing the refinancing risk? To get into the growth trajectory, you need fiscal space. So one of the policy narratives from the central bank was Operation Twist. And Operation Twist is also exactly this, like you simultaneously sell the short term and buy the long term, so that the liquidity infusion happen in the economy without much pressures on refinancing risk. That refinancing strategy was maneuvered in a perfect manner. So these are the ways in which we focused on liquidity infusion as a predominant way to respond to the crisis, but it has got its own limitations. And also, if you look into the financial stability report published by RBI, if you look into the NPA under stress scenario, for 2022 September, what was announced is not a, good picture. But, Ashima Goyal also, I asked that, she told that right now NPAs are under control, but maybe it's linked to the forbearance and a lot of policy we have announced also in the time of pandemic about, the credit, moratorium and all. But we have to wait and see what will happen in future, because if there is no corresponding growth in the economy and the liquidity infusion is happening, it's bound to, create non-performing assets and all, right? So we need to look into that aspects as well. And, unlike global financial crisis, we have not got into the liquidity trap or anything, but at the same time, a negative rate of interest is a matter of concern now. In the sense, our nominal anchor of inflation is 4%, plus or minus 2. So let's go ahead with 6. But right now, CPI inflation is a little above 6. And what's the policy rate? It's 4%. So officially, are we getting into a negative interest rate? And the consequences of a negative interest rate, of course, in terms of financialization, because in the term deposits and all, we are not even getting what we deposit, right? So there are, and in pension markets, if you put funds, and if it is in the negative rate of interest, then our parents may not get the money they have put in the pension bonds. So there are a lot of issues related to the negative real rate of interest and, zero bound interest rate. So these are matters of concern. The moment we believe that, monetary policy stance can do the heavy lifting and take the economy back to the prior pandemic levels or prior crisis levels. And I will end my lecture with highlighting two important innovative announcements happened recently in India. One is getting into central bank digital currency. We are getting into the digital infrastructure. And of course, India digital divide is quite strong. So getting into CBDC, it will help only the people who have access to the digital infrastructure, isn't it? But if you look at the articulation of Treasury Secretary in US, Janet Yellen, in the context of the dollar, digital dollar, she mentioned that that can strengthen the financial inclusion. When certain regions of our country is highly unbanked, when, the bank branches, that penetration was not great, then, this digital currency or the digital dollar can lead to financial inclusion. So that's argument. And another argument from Janet Yellen was that, these arguments I picked up from an article by Barry Aiken-Green. So you can also take a look into that article, that titled, Digital Dollar. So, I read that piece, and in that piece, another argument from Janet Yellen was that, she has announced quite a bit of huge fiscal stimulus packages, like cash transfers, child credit, a lot of, income transfers into the hands of people in the household. Okay, so she believed that the digital dollar can also ease that fiscal monetary policy coordination, and the way she distributes a pandemic checks or anything, that it would have been, that process would have been smoothened with the digital currency, given there is no digital divide. Otherwise, if the people don't have access to the digitization or the digital infrastructure, then things are different. But let's think about India. We have to wait and see how it is getting floated. But of course, cryptocurrency, there are a lot of, uncertainty. Like crypto, it's not a currency, it's an asset, a speculative asset. speculative assets are taxed at 30%. That's why it is 30%. And we also announced that the tax will be deducted at source. So it's a kind of a tracking the transaction, but it is based on decentralized finance. And of course, it's based on anonymity. Financial integrity is very crucial here. So even before floating the regulatory framework for the crypto, our country has announced tax. So what was the narrative? Using the tax policy, you're curbing a speculative activity that's happening in the economy through crypto transactions, which can affect the financial stability. Is that the case? Or are you giving, a kind of legitimacy or legality to the crypto by announcing taxation or taxing the crypto? So in this dilemma, all what Finance Minister has articulated in the press conference after her budget speech was that you can tax an asset, but that doesn't mean it's illegitimate or illegitimate. So tax officials also increasingly pointed out that taxing crypto doesn't make it legitimate. So it's not that. We need to wait for the announcements related to the regulatory framework. And as an economist, my hunch is our government will not say no to crypto. Government will not ban crypto. That's my hunch. Regulatory framework will be on board, but the way central bank governor articulates that it's not even worth the tulip. So there are confusions, but of course, Ministry of Finance and RBI are on board. There is no lack of or internal inconsistency or anything, but the deliberations are happening. And crypto, of course, mining is limited, but its transactions are huge. So energy efficiency, the other regulatory mechanisms. So there are a lot of issues to be talked about before we announce a regulatory framework and make it legitimate or legal. So I think that is the deliberations that's happening right now in India, but may not be like a blanket ban on crypto. That's my hunch, because if the entrepreneurs are doing cross-border transactions, and if this digital crypto can ease their cross-border transactions, that's based on the trust model. So what is that regulatory framework which can lead to financial integrity and the trust can function? So that's the way we need to support that innovation that has happened in the field of money and finance. But we have to wait and see, I don't know whether it will be banned. But CBDC, that's pretty clear, because it is a legalized, digital tender. So there, it's venerable. So there is no confusion regarding CBDC. We have to wait and see how it is going to get played in India. But CBDC is okay because, central bank, it's not the decentralized, what do you call, finance, or it is not. But the thing is that privacy, data privacy is quite crucial. There are many elements to be looking into regarding the digital CBDC also prior to the announcement. So that transition is happening right now in the Indian economy. But the prime, point is the digital divide. So if people are not people cannot access the digital infrastructure, then what's the point of digital currency? How we can lead to financial inclusion? So these questions remain. Now, the final point on innovation, that's a green bond. That is also quite a bit of confusion regarding the climate change commitments. Whether central bank has to look into the climate change commitments or, fiscal policy. In that case, economists are divided. And Rekhuram Rajan, many economists mentioned that, the political economy of climate change commitments, that is a cup of tea of a fiscal policy maker. But the political economy narrative, if central bank starts owning that narrative rather than focusing on its prime objective of price stability, that can lead to reputation risk. And Hansen's, that article in Monetary Economics, Journal of Monetary Economics in 2022, that also students can take a look into. He has put forward many arguments about the reputation risk of a central bank the moment they started talking about the climate change commitments. But lack of toolkit, may not be a sufficient argument to say that, central bank does not have any role to play in climate change commitments. That also we need to look into, because ECB, European Central Bank, Christine Lagarde is quite vocal about greening monetary policy and how she's doing it. Going for stress tests, green stress tests with the top banks. And Bank of England was the first, central bank to do the green stress test. So there are ways in which we can address the concerns, but of course, distinguishing between green bonds and the brown bonds, that's a political economy question. But if you don't look into the uncertainties and risk related to climate change, that can get into, the financial instability as well. So the moment we say that the RBI has to focus on financial stability, climate change commitments and risk and uncertainties, that can also, get into the financial instabilities, right? So we need to maneuver even, the question of how to green the monetary policy. But fiscal policy, it's clear, like the mandate, that is clear. And how we respond to that, what are the toolkits, that's a confusion, or little more clarity is required there. But India is the first country to go ahead with ecological fiscal transfer, in the sense that in the 14th Finance Commission, they have incorporated one criteria related to the climate change and the devolution of funds in that intergovernmental fiscal transfer mechanism. The devolution of funds, if you look at the scientific formula, along with population area, the distance, that is the inverse of the per capita income, along with that, those criteria, climate change, they have captured it through net forest cover. But of course, you can understand that forest is only one dimension when we talk about the climate change commitments. We need to look into other aspects, but, ecological fiscal transfer was an important initiative. Why I'm highlighting ecological fiscal transfer, just to say that in India, the fiscal authorities have started talking about climate change commitments prior to green bonds. It's not that first time ever that has happened in the budget, but we have started talking about it prior to the budget in 14th Finance Commission. 15th Finance Commission retained that criteria related to the ecological fiscal transfers. So that's one thing. Second is green bond. And in the overall financing of fiscal deficit, of course, that's happening predominantly through bond financing. You understand that there is a transition that has happened from the seigniorage financing to the bond financing in the context of India, right? Over the years, we controlled the monetized deficit, that net RBI credit to the government. If you look into the reserve money, that data in the handbook of Indian economy published by RBI, they give this reserve money. That's a high power money in the system, right? So one of the crucial components of the high power money or reserve money was net RBI credit to the government. And that exactly is a seigniorage, like change in the high powered money to GDP is seigniorage technically. So you can take a look into that data over the years, what has happened to this net RBI credit to the government. India controlled that component, but reserve money was going up because of another component, that's a Forex. Forex was booming, that's why we couldn't control the high powered money even after controlling the monetized deficit or net RBI credit to the government. So just imagine if these two components were raising simultaneously, then HPM was totally would have been out of control. But right now there's a re-emergence with relate to the financing of deficit, whether we can open up little bit of monetization of deficit, because the argument by Abhijit Banerjee, the Nobel laureate, the argument by Professor Kaushik Basu, if the counterfactual is where is the money, we cannot do expenditure, programs to tackle the humanitarian crisis, where is the money? So within the money, what is available and what is doable, we are doing. That means what is assumption? Revenue stability is the base for your expenditure decisions in the time of pandemic. But when the revenues are uncertain, then your expenditure compression will happen, right? The expenditure can go haywire if it is controlled, like austerity measures. That's what I meant. So the counterfactual is fiscal austerity. If you're hitting that moment, why don't you open up monetization of deficit to improve the fiscal space, but not getting into the fiscal profligacy, or it will not lead to mounting inflationary pressures because economy is below the equilibrium level of that potential level. So increasing fiscal space can only lead to the growth recovery process. So that's the way it is argued. Anyway, we controlled it from synergized financing to bond financing. Right now, predominantly, India's financing of fiscal deficit is through bond financing. And within this bond financing, first time ever, we are going ahead with the thematic bond financing. Thematic bond financing in the sense, earmarking a component of the bond financing for a specific purpose, that is green investment or green infrastructure, that green bonds. It is not the first time ever. In the private sector, this climate bonds, green bonds, these are very popular. But for Government of India, they announced for the first time that, government, within this financing pattern of deficit, a portion will be earmarked for green financing. But this can open the floodgate by incorporating many other thematic funds, thematic bonds, like you can have gender bonds in future, because in Colombia they have gender bonds, like a portion of the financing pattern of the deficit that is linked to the gender equality outcomes. And then the economic stimulus packages are short-run in nature. We have to give emphasis to the long-term public financial management instruments or the tools, and their climate change commitments and climate change or climate responsive budgeting is very crucial. And I hope that in the national adaptation communication, what's happening right now against the backdrop of the Glasgow deliberations, I hope that in future the budget will provide that national adaptation communication. And of course, mitigation is the crucial component and the significant component right now, but we need to get into this national adaptation communication. So these are the different tools in which you can address to the climate change commitments. So, Nitya, I stop here and take questions. Thank you. Chat box, can someone read it out to me, because it's tough for me to get into the questions from here. Over to you.
Yeah, thank you so much, ma'am. I hope I'm audible. Yeah.
Yes, you are. Yes.
Especially, having read all these references and having heard to all your talks so far, I can feel like a revision now. That was too good. I mean, you really combined all your references like every other day. So your book, especially, I mean, the book is such a rich source. I'm going to suggest my students to go through that book. I cite that book every time when I tell them that, crowding out is really not what you study the textbook. It's different when you look at the empirics. So yeah, that was really great. So I'll bring out the questions now, ma'am, one by one. So first question is, economists predict that the worst stagflation for India lies ahead as it is so globally exposed now. So what measures should RBI take to avoid or at least slow down this stagflation? So that's the first question. Yeah. Shall I read out all the questions, or you would like to take it one by one, as you suggest?
Go ahead.
Okay. So second question is, India's Forex reserves have fallen by another $2.6 billion. What are the shifts in the sentiments of the market that you expect due to this? So next question is, presently the Indian economy sees a falling household savings as well as falling consumption expenditure. So how does that augur for the economy? Next question is, what according to you is the best fiscal policy response during such times so that the people at the bottom of the pyramid are not slipped further into poverty? So these are the questions, ma'am.
Oh, great questions. That last question, let me take first. What could be that fiscal policy measures to avoid the people, suffer in the low rung of the pyramid? That exactly is a question. There, the policy imperative of the center government, of course, principle of subsidiarity is important. The center government was like, we were focusing on the employment guarantee policy. and not the cash transfers. But when there is a livelihood crisis, of course, it can be a mix of the basic income and the participation income. Participation income in the sense by giving importance to the employer of last resort policy of the government and provide people income by their participation in the economy. So here, we could have announced a tax cut. That's what we thought, but government has articulated that stability and predictability in the tax regime is crucial. So increasing or decreasing the tax rate is not plausible at this moment. So that was the way, government responded to the question of using the tax policy to avert the crisis. So to a certain extent, that is important. But at the same time, she also mentioned that we have not designed any COVID-related taxes to get out of the crisis by increasing the fiscal space through the increasing the tax rates and to hurt the economy further. So to me, taxation should have been used for tackling that livelihood crisis to a limited extent. And here I'm not talking about the direct taxes, because you understand that the people who pay the direct taxes is just 4% or something, because around 8 is only on the organized sector, and the people who are in the tax net are 4%. So I'm talking about both the direct and indirect taxes. So rationalization of taxes, even in the GST, that is very crucial. It's ease of doing business, and the rationalization of the rates in the GST regime is also very crucial. Now, another option I mentioned about the cash transfers, and we have not got into a huge stimulus packages related to tax transfers. Rather, we have gone for a targeted cash transfers, but again, 500 rupees, the targeted cash transfer, how it's going to make a change in the life of people. That's question number one. Second, the administrative and that what you call the establishment expenses and the way it is transferred, those expenses are greater than the real beneficiaries, or the money flowing into the hands of real beneficiaries. So one way to tackle is to make the digital infrastructure perfect. And the digital infrastructure in public finance is so crucial when we think about, transferring the income into the hands of people. So that's the way, we could have responded. Then third is the small and medium enterprises. There is a crisis over there, but what we have responded was through the, credit related policies. But credit infusion was uneven, and you can take a look into the credit deployment statistics of RBI. There, large industries access the credit, but small and medium term, it's around 1.2 of the entire credit deployment or something like that. So, if you look into the growth rate, it may show that, YOY growth rates may be good for the small and medium term enterprises, but it's not the case when you look into the composition, who access the credit. That's a matter of concern. And even the Ponzi finance can happen if the credit deployment and the credit offtake is not supported by markets and the demand. So that's a limitation of the credit related policies. So we need to think the policies related to the crisis at the low end of the pyramid, because otherwise supporting the state business relations is leading to a very skewed recovery process in the context of India. So that's my response to this question. Then household savings, of course, it's plummeting, and people are even diversifying their savings from the kind of term deposits to other little bit of equity markets and all. And rate of interest is the potential variable here to protect the household savings. But as I mentioned, the dilemma is we're keeping the interest rates at the lower level for the growth recovery process through the credit offtake to support the investors. But at the same time, if the interest rates are kept lower, that can lead to low financialization of savings in our country. So that exactly, that variable interest rate, that's a crucial determinant behind this. Now, Forex, of course, you can understand that this taper tantrum and the plausible series of increase in the interest rates by the US Fed, unless, this hot money is very volatile now, because hot money responds to the interest rate differentials. So how to prevent that capital flight? The only way in which we can prevent the capital flight is to increase the interest rate, but that's not possible. So in 2013, when such kind of fluctuations happen in the Forex and especially this foreign portfolio investment, that started becoming flighty. How we responded to the taper tantrum, we have done capital controls, but that didn't work beyond a point. Then we intervened in the Forex markets. That also didn't work. So maybe this macroeconomic fundamentals we need to work out in order to tackle this crisis. So when we talk about macroeconomic fundamentals, I'm aware of my fiscal deficit GDP number as well. But there, if you are so strict to get 3%, that will also be detrimental. So how you communicate that accommodative fiscal space is very important when you talk about the macroeconomic fundamentals. If it is not 3% of GDP or deficit, why it is so and why it is high and how it is articulated, that is very important, because capital defense, capital controls will not work. The only variable which is significant here is interest rate defense. But whether we will be able to do that, hurting the growth recovery process. So these are the dilemma of the central bank. Now, getting into stagflation, unlike the other countries, that stagnation in production coupled with inflation in prices, that's not the exact model in the context of India. Of course, we have stagnation related to certain sectors like contact intensive sectors and all. Of course, the growth is not recovering. But, of course, it's a high frequency data on the basis in which I'm speaking to you that there is recovery. But there are, elements of recovery in certain sectors, but it is not even. We need to, focus on other sectors as well. So that combination of stagnation in production and inflation in prices, that may be the cases with other countries, but stagnation, of course, it is sectoral, highly sectoral, and we need to look into those sectors, especially they are contact intensive sectors. So that transient nature of stagflation needs to be looked into, because lockdown was the predominant strategy which we followed in Indian economy to tackle the crisis. And of course, God forbid, this crisis should not happen once again, because I heard that there may be a peak in June. So the preparedness in the economy is very crucial to avoid a stagflation or a potential, what we have to focus is on health sector. You know why? Because otherwise this health crisis will only mount into prolonged macroeconomic crisis. So that potential of investing in the health sector is very crucial this moment. And not only from the health insurance perspective, like when the event is happened, you support, no. But from the preparedness perspective, like we have to use this crisis as an opportunity to improve the investment in the health sector, primary, secondary, and tertiary sector, to avert a crisis in the future. And so that's very predominant, not the ad hoc kind of health spending on vaccination or anything, but ad hoc spending on vaccination plus a fundamental, a structural, that support which is required for the health sector. Because over the years, due to this fiscal rules and all, the health sector suffered, social infrastructure suffered, capex suffered. So our numbers look good. It was 3% of GDP, the deficit. We faced out revenue deficit, and state governments also faced out revenue deficit. But the costs were huge, and now we are at the receiving end. So maybe right now we can think about the bad equilibrium and all related to fiscal rules later, because we will get into those numbers and discipline later. But right now, spending is very important, and spending in public health infrastructure is of paramount importance. Otherwise, this can be, this can lead to prolonged macroeconomic crisis and stagflation or whatever it is. So health, that is very crucial, and God forbid that there should not be any, peak in June. Nitya, over to you.
Thank you so much, ma'am, for answering the question so patiently. And we're really, really grateful that you went past the designated time and you spoke at length, covering the length and breadth of the topic. And we're really grateful. So I would like to now call upon our department convener, Dr. Aradhana, to give a formal vote of thanks to you. Thank you from my side.
Indeed, as Nitya said, it was an invigorating session, ma'am. And you spoke in the simplest possible manner. Even a person without economics and technical jargons would be able to understand and take away such good points, as regards, the system that we are in and the kind of, eventualities that the economy is going to face. So really grateful, ma'am. It was a thoroughly beautiful session with all great, simplified analysis. And at the same time, you also gave a look at through the different, good research papers, which our students would definitely, remember and take their opportunity to go through them, as regards when they are trying to do vivid research and, kind of understanding the analytics of revival and recovery in a much better way. So I find no words. In fact, I have to say that it was indeed a great evening, and you charting out, time for us, and that too at this evening time, actually means a lot. And we look forward for your, physical presence in the campus. And we really look forward to hear you on many more, contemporary issues, and then look forward also for your guidance in the things that we do. And we would request you to actually, be, answering our mails in case we put up anything to you, ma'am, for your, for our greater understanding, and you as an expert on the, public finance fora. So I ensure that, our students will seriously, be understanding more of the macro and the intricacies of the micro as the economy and the RBI. I really appreciate that you took forward the question of, the independence of the RBI. And this is one thing which I, as a student of economics, always have, been enamored, as in, why can't we, I mean, if the RBI is independent, I think like the Federal Reserve, we can, have charting out of many good policies. But yes, India is a different country, though we are similar in democratic way. We are both democracies, but still, I think, the political factors is still playing a very predominant role. So let's hope, and with your good words and with the good things that our students have learned today, we will definitely remember, and I think, carry out, certain things which in our research and in kind of understanding of the economy that we do every day. So thank you so much, ma'am. Thank you so much. It was indeed a great session. I hope our students have really gained, and we will really be, looking forward to future many more such sessions. And I think that would be the greatest thing, mankind can do, giving, interacting with the young people. I think, as you said in the beginning, that that's the best thing one can do, interacting, with the young people, the future of the country. And we understand that these are the, students who would really maybe follow you up in the long journey of, economics and finance, and make the country proud, as you have done, and as many people at your level have done. Thank you so much, ma'am. Have a great evening. And well, before I maybe wrap up my talks, I would be failing in my duties if I don't thank my, student body, the Association of the Business Economics and Management Studies. They are really passionate. They are really hardworking, and they are always full of, doing new things. And this is how they keep on organizing interesting webinars. And that is how we had this opportunity of interacting with Professor Chakraborty. So thank you, my student team and teachers. Nitya, thank you so much for, connecting this and making it happen. I would be also failing in my duty if I don't thank, first and foremost, though at the end, that is our principal, sir, Dr. J.B. Singh, And of course, today acting principal ma'am, Bipinder Kaur ma'am, they have always been instrumental, and always motivating and guiding us. Yes, you do organize these kinds of interesting, webinars, and this is how the institution has been, doing and carving out a good place for itself in terms of, the intellectual, you could say the achievements that we have. So, and that is all, the technical team, the student team, and of course, without the internet Baba, I think he needs to be thanked the most for making this possible, feasible, and that is all which I had to say from my side. Yes, over to you, my student. Anything you have to say? Riya, Nitya, and Amanpreet?
No, ma'am, we are through with the event. So we could
Okay.
stop the recording now, and we'll be sharing the recording with all the participants. Thank you so much for joining in today.
Thank you. A special word of thanks to Ria and Jeshwant, no?
Karan and
From the student leaders. Thank you
yes.
so much. And thank you. And hope to see you in campus,
Thank you,
as
ma'am.
ma'am mentioned. Have a good
Certainly, ma'am. We are eagerly waiting for that opportunity, ma'am. Thank you so much. So thank you all. Bye-bye.
Before everybody leaves, a link has been shared in the chat box. Please kindly fill that feedback form to ensure that you receive your certificate. And it will also ensure the attendance for the event. Thank you.
Okay, thank you all.